We certainly saw the impact on the dollar in terms of it erasing its 2019 gains. I believe when we've spoken before, your outlook for the dollar has been dollar strength, and generally you are positive on US assets. Is this something that continues for you through to 2020 based on a Fed on hold, or if anything, the dots showing the bias was to a hike, not a cut, which is what the market is pricing?
Yes. Well, I think the Fed has very, very subdued inflation, and also the Fed and the uber dovishness from Powell yesterday. The main point was they don't think that there's a tightness in the labour market. There's 160 million people in America have a job, but there's actually 100 million that are not in the labour force. And they're quite concerned that that excess supply of labour is going to keep inflation subdued, and therefore interest rates are going to remain very, very low.
You know, one of the big problems with the U.S. labor market is that so many people have jobs they don't like, or jobs with which they can't sustain or support a family. Is that the same problem? Do we have the same problem here in Europe?
Yeah, I think there's significant slack still left in the European labour force. But within America, the main part is that actually wages are now on aggregate over 3%, but the low to middle sector in the labour market, actually we have 4, 5, 6% gains. And this is going to suck in quite a significant amount of the labour force and the non-labour force. So this was really the main takeaway from Powell yesterday, that the tightness in the labour market is not an issue, and they're going to basically have to see some very, very significant deterioration in job numbers if they were going to cut again.
Based on the outlook for the Fed and the ECB and perhaps other global central banks in 2020, Martin, would you prefer to allocate more to equities or bonds in 2020?
Equities is our main play. And that is because we have substantial monetary easing. 60 central banks have cut rates this year. The emerging market countries are going to continue to cut rates. And fiscal easing, we have $3 trillion of global fiscal easing. The last 6 years, the average was closer to $2 trillion. And that monetary and fiscal easing combination makes us very, very bullish US and global equities. Our 18-month outlook on the S&P is 4,000.
Martin, what do you think about U.S. equities having risen already 25% so far year to date? I mean, don't you think investors should take some of that money off the table heading into Christmas?
No, not at all. Investors should not be trying to time small market issues. They should be trying to take a secular structural assessment on where global equities are going to be, and particularly US equities leading. A decade ago, US equities were 30% of global stock market. Today, they're 42%. And that trend can continue, and simply because of the factors that I've mentioned. And US equities have performed very strongly this year, but that just reverses last year.
Right.
So actually on a 2-year view, the last 2 years, US equities are almost flat. And people should be looking to, the call options is probably one of the best ways to play if you don't want to actually purchase at this level, or to look at call spreads over the next 12 or 18 months.